Sponsored by Anthony Mendez.
AM 1220 KDOW and Money 2.0 present The Real Estate Report with Tony Mendez and Gordon Hines. Bay Area real estate and mortgage experts with over 25 years in the business. Now, with an in-depth look at this week's local and national real estate news and what it means for you. Your hosts, Tony Mendez and Gordon Hines.
Welcome into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
So another wonderful day in California.
It was a wonderful Thursday, that is.
It's 100 degrees on the East Coast. It's 70 degrees here, and that's why a lot of people love. That's why I moved here.
So you moved here for the weather?
I moved here. Well, the weather, it didn't, distract me at all. I mean, it was a wonderful benefit of moving here.
I moved here for the real estate values.
Okay.
So there I was, 25 years ago, ahead of my time.
Ahead of your time.
Maybe that's why I do.
Man of your times.
That's why I do what I do well. Good, right?
It's call-in show, 800-516-1220, 800-516-1220. You can email the show, tony@bayarealoansource.com. We have a great email I want to get to today. It's kind of been the theme of what we've been talking about, Gordon, over the last, 20 shows, how equities are going up or values are going up and people are taking home equity lines out of their, accessing some of that equity there and doing renovations. And what do you do with that once you've completed the job and now you have a first and second loan? So that's a great email from Bill in Piedmont. And we did a transaction with this client. He's asking me what to do with his first and second loan. And I think a lot of people will be surprised about that. We also have some information from Fannie Mae. Part of what this show is about is keeping people up to date. And a couple years ago, we saw Fannie Mae and Freddie Mac. They increased their loan limit. First, back in 2008, they increased them all the way to $729,000. Is that the right number?
Yeah, at that time they increased it to match the FHA rates at that time.
Then they decreased it, and then they put it back up slowly to $625,000, and then so on. And now it's $679,000. That started at the beginning of this year, and it's helping a lot of people that are looking at refinances and buying houses with 20% down, and you can get a good $800,000-$900,000 house and still be in the conforming limit and follow all those really good guidelines without going to those jumbo guidelines.
Well, that's one of the good things that Fannie Mae and Freddie Mac has done over the years is to kind of manage the stress of real estate. As values go up, they had to do something to kind of keep in line with the times. And by raising the loan limits, you allow more and more people to qualify on standard loans instead of having to go to jumbo products, which are tougher to qualify for.
And those have gotten easier, though. And the rates are really good. That margin between the 30-year fixed conforming and the 30-year fixed jumbo has shrunk quite a bit. In some cases, it actually flip-flopped where it was cheaper to get a jumbo. But it's harder to get. You need higher credit scores. It's harder to get cash out. It's almost impossible to get a second loan on top of them if you're at 80%. So there's a lot of really tricky things that jumbos go through. But the point is that we always try to keep you up to date with products that are out there. And there's one particular product that we use with an investor that allows you every county now. Pretty much every county that's listening to us right now is at the high balance of $679,000. But we have a lender that does what they call a nationwide product, and they go up to $679,000 in every county. Every county, whether it's a $454,000 or $679,000. So I just wanted to throw that out there. If you have any questions about that, you can always email me, tony@bayarealoansource.com. Some of the other stuff we're going to go over, Harvard did a study that homes are a lot cheaper today than they were back in 1980. I'm going to kind of throw that out, but because the next article comes up saying housing affordability is the worst it's ever been. So it's really tough to discern what news you really want to follow out there, Gordon, isn't it?
Well, as we always talk, there's a lot of news on the web. You got to qualify and quantify the news. As you know, our president's always talking about fake news. There's a lot of news out there. You have to go back and look at the actual source. I'm always talking about statistics that we read on all the time. You got to go back and validate these actual statistics and make sure they actually apply to you.
I think what we do on the show is we follow trends as opposed to actually trying to quote people, real statistics. The trends are there. I mean, we see there's less buyers right now because they think that home prices are too high. We have more people who are thinking that it's a good time to sell, and we're seeing more and more of these stories. So the more and more we see these stories, is that a sign that we're topping out a little bit?
Well, I mean, people are, I call it the spectrum. People are always playing the spectrum. If you look, listen on TV, listen to the economic news, wherever the market's doing, there's always some guy out there counting the market doing opposite and vice versa. And that's because those people are in the business of selling, I call it talk. Just like talk radio, you have to talk in order to continue to have talk radio. So a lot of times I call them Doubting Thomas. You got to actually look at the actual economy, look at the actual economic figures, look at the economic indicators. You can actually figure out where we are in the spectrum, regardless of what the so-called experts are claiming what's going to happen for the next 12 months or 16 months. No one really actually knows. It's predictions, it's crystal ball, I call it. So I tend not to kind of hinge on those things because I realize that it's just talk.
Are you one of those type of investors or real estate experts that says real estate always goes up or real estate is always a good investment?
Yeah, I believe real estate's always a good investment. It's a long-term investment. That's what we always talk on the show. That's why we have a 30-year mortgage.
I just hear too many people say real estate goes up in California, but then 10 years ago it was going down.
It does go up, it does go down. But if you look at, once again, you just said trends, right? If you look at the trend of what it does over a long period of time, just like the stock market, there are periods of time where the market's going to be down. There are periods of time where the market's going to, but the overall complexion of the marketplace has been upward trend, and it's been a good investment stock market. Same thing in real estate if you look at over the years.
So we're getting about, on average, say about 8% to 10%, depending on where you are in the Bay Area. Do you still recommend if somebody is in there for speculation to say, you know what, I can afford it? You were talking to me the other day. So you have a property over here, and you're looking at very small rates of return as far as appreciation, and then if you were to put in a property over here and we started running some numbers, you'd be up $40,000 if you were to have a property here. And let's say I am speculating. Should it make more sense for people or do you still think it's a good time for people to speculate on another 10% increase here in the Bay Area on home prices? Well, or do you just say you target a certain price range, knowing that has a better chance?
I believe speculation is good, but speculation has to be left for the speculators. Speculation is not for the novice. For example, if I buy a property in a cash position, I speculate, regardless of what the market does, as long as the cash, I'm not taking food off my table, it's not going to affect me. I can always hold. But for a guy leveraging, doing maximum leverage on speculation, the market turns, he's going to actually lose his shirt. And I think that's what we saw happen a few years ago. We had a lot of people out there that were speculators, that were buying properties with 100% financing, no skin in the game. And when the market turned, they had no way to substantiate, sustain making those payments. And they ended up walking away from a lot of those properties simply because they couldn't do it.
Yeah, and on that,
actually hurt.
On that note, we really haven't seen a lot of people over leveraging, have we? Well, the lenders kind of stepped in and said, well, you can only do this much, and they've loosened it up, having a little slightly higher LTVs or loan to values and so on. But when it's all said and done, it's been pretty quiet on that front.
Well, the market made some changes. The market made people put skin in the game. So the market has make you put down 25%. So if the market does speculate, if the market does go somewhere different, you have room to grow. You have actually time. I'm not say time. There's money to lose. So that's the reason why if you 100% finance the market starts speculating, you're automatically in the red. But if you got 25% down, the market goes down 10, 15%. You're technically not in the red. So there's no actually really need to kind of walk away from that property and start doing fire sales.
Well, at the same time, there's also jumbo products that allow you 5 or 10% down, and you can go in with a little bit of money and speculate with only, if things go sideways or down, you only losing 5 or 10% of your money. Yeah, your rate's going to be a little bit higher, but you're speculating on the appreciation and maybe flip it. Getting that property is tough, though. Finding that there's not a lot of people still say, are there any deals still out there? I know your answer to that. There are, but you're still going to pay top dollar for them. And that's where I saw the market change about 4 years ago, where people were spending top dollar for properties that didn't deserve top dollar. And that's when I should have probably pulled the trigger a lot more often, because they're going to fix that property up. The next guy's going to fix it up. That's going to be worth more. And it keeps snowballing upwards. And we've had a great 4 or 5 year run on this.
We've had a great run as far as appreciation is concerned. We've had a great run as far as low rates are concerned. I mean, we had a 30-year fix. We looked at a few applications we did 2 years ago. We were just reviewing some of the applications we did. And I just pointed out we did back in August of 2016, we did a 30-year fix for 3.25%. That's incredible. So we had a long, sustained run of low interest rates. We have a long sustained run of great appreciation. I think everything, I'm not going to say comes to an end, but everything needs a breather. I think the market works on change, so it has to come back down or reset itself and get ready for another run. So we know that whatever goes up does come down. Market will come down. When it's going to come down, I can actually tell you. If I bragged that I knew, I wouldn't be talking on the show right now, but I know it's going to come down. I couldn't
You'd
tell
be
you
pretty
when,
busy
and you just
somewhere
have to
else.
make sure that you kind of brace yourself and be prepared for when it does come down, that you're not caught with your pants down.
So, yeah, you are going to see more and more articles like this one. It says, is it time for the next recession? How to prepare yourself for it? How did we get to where we are today? Some of the policy mistakes we made. What will a recession look like? This was a really interesting kind of angle. First, they said that if there is a recession, that all recessions are different. It could be commodities, it could be real estate, it could be, but they're all, you always see some sort of unemployment numbers increase, but you also see interest rates drop. The Fed will probably, quote unquote, cut short-term rates to near zero again, as it did in the Great Recession, but it could be starting from somewhere between 3 and 4%. A smaller cut means a weaker stimulus and a longer and deeper recession. So we're not talking recession. Don't get us wrong. We're just talking that we are talking trends. We are talking that if you do go look at the chart, there is a recession on average every 7 years. And it comes in different forms with different faces. So I don't think real estate. And if you read this one, I'd be glad to send it to you. You can email me, Tony@BayAreaLoanSource.com. It talks about how real estate is not on the map right this time. It's not a target.
Well, I mean,
and you go back to the economics of it. We're already raising interest rates, and rates are Freddie Mac has it at 4.57%, and it's the 10-year yield's trying to go over 3%, but it's not. And the Fed's already raised rates 2, 3, 4 times already, and they're planning. And here's another article where Powell's saying he calls a very strong case for more interest rate hikes. So.
The Fed are not. If the Fed is not raising rates, if you're talking to economists, the Fed is not raising rates to kind of slow the housing market down. The Fed is raising rates to kind of offset inflation. That's what the whole idea of balance the economic scale is. So if you look at rates, you're trying to say it's going to stimulate the real estate market in a downward position. I mean, it probably will, because the more you raise rates, the more the affordability factor goes up. But that's not the job of the Fed to kind of control the real estate market by raising rates.
Well, all of this ties together. I mean, we have a bump up in home ownership rates over the past couple months, so that's good news. So we're seeing more and more people getting into homes and more home ownership, and then you have the Fed raising interest rates. I think they're actually preparing for a recession. If they don't raise interest rates, they can't go down. They can't bring interest rates down to stimulate the economy.
Well, we've already had seven interest rate increases in the last 24 months.
And there we go. We have 7 that we can go down.
Okay. Well, we had a low. Matter of fact, if you go back to reel back the news, many years ago, many economists or experts were already claiming that the rates are too low. They left rates. Yellen left rates low for too long. And those people, that proved to be totally false. That's what I'm saying. It's just talk. You just got to be able to validate that information.
There's an argument. There's another argument too that, hey, maybe we figured it out. Maybe we're going to be in a really long period of low interest rates and healthy economy. We'll come back after this break here on AM 1220 KDOW. Call the show 800-516-1220. 800-516-1220.
This is Money 2.0 on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
Every once in a while, we give you some updates on what Fannie Mae, Freddie Mac, FHA, all those lenders and people.
Not every once in a while, every week.
Every week,
we tell us what rates are doing.
Fannie Mae is coming out and saying that there's a lot of condos out here. So if you haven't owned a condo, you're looking to buy a condo. Condo litigations, Fannie Mae's new rule, they're allowing investment property transactions up to 75%. If you have, they're changing some of the rules on single entity ownership. Let's see, lawsuits. They're changing the guidelines on any lawsuits that the project may be in. Commercial spaces and things like that. They're allowing commercial space up to 35%. So there's some new rules that that really needed to come around several years ago. But
And what he means by that, when you're doing a loan on a condominium, there's a condominium questionnaire we have to have filled out, and one of the biggest questions is the association litigation, and typically if there was any type of construction litigation, or anything going on around building, Fannie Mae or Freddie Mac wouldn't touch that program. Now they've come back and kind of redefine it a little bit more, give us more leeway in what actual litigation they will allow, and now that means you can do more loans on the Fannie Mae guidelines. Plus now in the inner cities, a lot of condominium complexes are going up, and on the ground floor there's commercial spaces going on, and upstairs there's residential. Typically Fannie Mae didn't like those before. Now they're beginning to adhere to those and lend on those.
Litigation one was a big one.
Yeah.
We back in the day, and I'd say the day, last 10 years, a lot
That makes you
of
sound like an old man back in the day.
I'm old enough to say that
Back in
now.
the day.
Hey, Sonny, what's that thing hanging out of your ears? Eh? But that's what you want out of a guy who's doing your real estate. Whether it's your, listing your property or doing your mortgage, you want somebody who's been in the business for a while. We're not going that direction today, but we do like to talk about how you should use professionals.
We always talk about using professionals.
We always talk about that.
We're bullish on people, on professional people, professional contractors, professional agents, full-time agents, people that do this for a living. You think we get better service and better results, and it's all better for our business. That's where we see it.
Freddie Mac has the 30-year fixed at 4.57%, the 15-year ARM at 4.04%, and the 5-year ARM at 3.83%. We had a great email from Wayne in Piedmont, and he's talking about refinancing his first and second. Well, he was talking about trying to figure out what to do with his second, because it's a higher rate. Fed it came like the day after the Fed increased the rates, and he's like, "What do I do with this? My rate's now 5.75%. I have $180,000 or $200,000 I owe on that."
So I'm gonna assume his second is an equity line.
Second is an equity line. It's adjustable to the prime rate. It sounds like it's prime plus 1.25, maybe even 1.5. And there's people out there that have gotten second loans or equity lines recently who are prime plus quite a bit, 1 or 1.5. And you're adjusting. And when you see another article here, Fed chair calls a good case for a stronger or a strong case for higher interest rates hikes this year. And you wonder if you're going to be able to afford it, and does it make sense to refinance out of that second? Well, there's a couple options. One, you can replace it, you just get another one. Two, you can kind of accelerate the payments on that. Remember, those things come with interest only, and the last thing you want to do is pay interest only for 10 years and then get stuck with what they call a recast. And now you're 20 years at whatever interest rate it is, and then your payment could literally triple with principal and interest and a higher interest rate. So what do? You can replace it, or you can do a total you pay it off in cash, or you can do a total refinance. And we ran the numbers, and I think a lot of people would be surprised out there that and he's had his first loan at 3.75%. He has his second loan at 5.75%. And actually, if he was to refinance into the current rate, let's just say it's 4.5 today, 4.57, and he stretched that out over another 30 years, but he kept making the same payment he was making currently. He actually pays it off 5 years earlier. I ran the numbers.
Okay. All right.
Okay.
I trust you.
So, I hope so. I hope so. I hope you're telling everybody that you trust me.
Okay. Well, I'm an advocate of equity lines. I think everybody should have an equity line in their property, but an equity line requires a lot of money management. It's not for the novice. And the reason why I say everybody should have one is emergency money. And I've got a great case right now. There's a transaction I'm doing for a young lady. She's purchasing a condo. She's got about 4 rentals. And when you have a lot of rentals, Fannie Mae requires you to have 6 months reserves on each property. So if you got 4 properties at $2,000 a month, that's $8,000 times 6. That's $48,000 reserves you have to have. The great thing for her, she just got an equity line on her primary residence, a $50,000 equity line. She drew that money down and put it into her account, and now she has that reserve. As soon as she gets past her loan, I'm assuming she's going to pay that money back. So it's money management required for these loans. They're not meant to carry that balance for long periods of time, because as Tony said, those loans do recast after a period of time. You got to be really careful, because there's no I didn't know, and that's where you can put your property in jeopardy.
We'll come back after this break here on AM 1220 KDOW. I'm Tony Mendez. That's Gordon Hines. You're welcome to send us any emails to tony@BayAreaLoanSource.com or visit our website, BayAreaLoanSource.com. We'll come right back after this break on AM 1220 KDOW. This is the Real Estate Report.
This is Money 2.0 on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
Always love to hear from our listeners. 800-516-1220, 800-516-1220. You can email the show, Tony@BayAreaLoanSource.com or Gordon@BayAreaLoanSource.com. So much to talk about. What's on your mind, Gordon?
Well, you better have a lot to talk about. This is a talk program, so we can't stay and look at each other.
Well, you see, we sit and talk all day.
Yeah. We get a lot of calls all day, people looking for scenarios, asking for our expert opinion. And we always like to kind of, give our opinion based upon our experience. We got a lot of people that are looking to still buy the market. We're still writing a lot of pre-approval letters for different clients. As a matter of fact, I feel good today. We got a client that got an offer accepted. This was his 24th, believe it or not, 24 times of making offers on properties, and we said the summer months are always the best time to get because a lot of people go on vacation, and he believes that he's fortunate finally got an offer accepted.
24, huh?
24 actual pre-approval letters I actually wrote for this client, and he's finally been successful at being renting for like 10 years, and this is he's the first-time buyer, and he's buying a property in San Leandro. So those are all good, positive things we like to talk about. We believe the tenacity. He tried many different agents. We could say maybe I was jinxed by using the same agent. Tried different agents, still with the same outcome, but now he's been very successful, and we always like to talk about those type of programs. So I think when you look around the marketplace, we're coming up now on the end of the first half of the year. 2018 half year is almost here. I think we got one more show in this quarter, and we're kind of looking to see what's the second part of the year is going to bring and where is that going to lead us as far as real estate is concerned. That's what I'm always excited about because our marketplace, we're always looking ahead. We're always 3 months ahead in our marketplace. Right now, we're looking at first payments due in August right now when we do our projections. So we're always 3 months ahead of the game, and we're always trying to project what the end of the year is going to do and how we're going to feel about our business that we're in.
So what's your feeling?
I feel good. I'm like James Brown. I feel good. I mean, I feel good. I've always felt good about our business because I think we've made a lot of changes. We got out the difficult loans. We believe, like I'm always talking, we will, as I mentioned earlier, market prices will come down. But if it does happen, we're going to have a soft landing. I think anything that happens in our marketplace is going to be crisis driven. I don't know, maybe this trade thing that we have, it looks like the war with Korea has now been put on the back burner. Now we're looking at this big issue with China as far as trade deficits and this big trade game that we're going to go into. I don't know how long that was going to sustain a dent in the marketplace, but it's going to be some catastrophic event outside of our normal business that's going to cause our market to curtail.
Rates and affordability is something I pay attention to. Leading to the end of the year, we have another big buying season coming up, and that's the fall. A lot of people look to buy. They're trying to move into a place before school starts and vacations are over. And if I was a buyer, I'd probably put off my vacation to just stick around while everybody else is on vacation and try to snarf up one of those houses. But I always pay attention to that. Affordability is something that we've been paying attention to. We just got another report from CoreLogic saying that it's come down a little bit from another month in a row where it's just a little bit more expensive to buy a house. Home prices are going up faster than incomes. Rates are creeping up a little bit, although they did come back down a little bit. We have a lot of buyers though, and that's where the market really starts to make sense. If I was a seller, I wouldn't be concerned at all. There's buyers lining up. Every realtor we talk to, there's buyers that are multiple offers over asking price. That's still very prevalent. The Bay Area leads the nation in over asking price percentage, and there's other reports. Like Redfin, for example, their projections on home prices and their variances from their Redfins are really becoming a really good website, by the way. If anybody hasn't heard of them by now, which is crazy, they have some good insight on their home prices, and so I think you recommend it every once in a while as well. But I look towards where's our buyer pool coming from, where's our seller pool, where are people moving. There's an abundance of stories out there that can talk about where millennials are moving, where companies are moving, where the jobs moving, where to buy. These are the things that I'm looking forward to the rest of 2018.
Okay. Yeah. With that said, we'll be back.
We'll come right back after this break here on AM 1220. This is Tony Mendez and Gordon Hines with the Real Estate Report.
This is Money 2.0 on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
San Jose looks like they might be relaxing rules on granny flats, Gordon. Something that I lived in Alameda for a long time, that they wouldn't do any of that, but they need to. They're going to go, okay, we can't get through the tunnels and the bridges. It's just jammed up traffic. But, get a place like San Jose, it's just, where else are people going to live? And I think it's great news to hear that a city is going to say, we're going to increase. I think they're saying 18,000 lots where flat is possible, adding 18,000 possible units up to 2 bedrooms, I think, on each. What do you think of, adding, and they're also decreasing the size of the lot that is required for that to fit on. So are we going to see this more often around the Bay Area?
Yeah, absolutely. Without a doubt. Most cities are now beginning to adapt that rule because it's state law. State law allows for what they call auxiliary units. A lot of cities, like, for example, Oakland, what they have done is they have actually, to help this out, is actually restricted, relax, I should say, the parking requirements. Typically, they used to require 1.5 parking spaces per unit. So if you got 2 units, you need 3 parking spaces. And if it's now within a mile radius of a BART station, in fact, there's no parking required. It's off-street parking. So I think that type of rules, because of the authenticity of public, the option of get public transportation now has gotten better with the ride shares and the Ubers and the Lyfts. So a lot of these cities now are beginning to realize this, a sign of the time, as Prince would say, and allowing for some of these more high-density housing in some of the neighborhoods that have been really need housing.
Yeah, I immediately think of how people are going to get their money. That's obviously, because that's what we do. And are they going to get an equity line? Are they going to do cash out? Are they going to sell stocks or whatever? But at the same time, that's jobs, more construction jobs for contractors out there and laborers. And they're generally high-paying jobs. I don't know if anybody out there who's listening has been in construction, but it's not. You can make some good money. So you get a good union, get a good company, you can make some good money. So I honestly think that the big wave of employment for the U.S. right now tied towards real estate is in the construction side. My brother got into it just in time, and he landed himself a great job doing kitchen and bath design, and he's doing very well doing that.
Yeah, construction is a great demand here in our area. One, because of the demand for housing. There's a lot of building going on. As building go on, it requires more and more skilled labor. We had the big fire up in the Napa, Santa Rosa area, and a lot of people up there now are rebuilding. A lot of people are doing what we call the buy and resales. Those all require construction. The people are now converting some of their garages that qualify and that are in certain cities into auxiliary housing that requires contractors. So contractors are in demand. I've got a client of mine that was building a house, and him and the contractor fell out. The contractor just stopped showing up for work, and he's now trying to finish the project himself. And he's saying, Gordon, I can't find a contract. And when I do find a contract, the price is outrageous because of, once again, just like real estate, supply and demand. So when work is plentiful, prices go up. When work is not so plentiful, prices go down. Sign of the times, as I call it.
Well, I hope that people do their research when they do it. I wouldn't recommend doing this unpermitted. Definitely get your permits. We still run into properties that have unpermitted additions or modifications to their house that, lenders have kind of eased off a little bit. They'll say, okay, there's a bathroom that shouldn't be there, or that bathroom should be a kitchen and the kitchen should be over there. And they're saying, okay, we're going to value the house at, instead of a 2 and 2 or 3 and 2, or do it as a 3 and 1. And they'll do the comparable properties in that way. So, but they're loosening up a little bit. But if this was 5, 6, 7 years ago, It
was tough. The market was really tough back then. I mean, we struggled with some transactions we just couldn't get done, not because the borrower didn't have the credit or the ability to pay. It's just that the lender just wasn't willing to lend. It was a time of crisis, and every I has to be dot, and every T has to be triple crossed, and it was difficult. So now I think we're seeing restrictions have come down. A lot of lending rules have relaxed. We're more and more products. We always talk products is what pushes our marketplace. The more products that are available, credit score restrictions come down. We can go below the 550 now. FHA goes 580. We have the bank statement programs. We got all kinds of programs now to help stimulate the growth and help maintain the substance of our marketplace.
What do you think of the whole somebody looking to build or an addition to their house, renovate or whatever, and they go, okay, I want to get an equity line. Equity line interest isn't deductible anymore, but I am doing a capital improvement on my house, which can also change how my taxes are looked on the property if I do sell. And they're going, what's the best way to maximize it out? How do you play that? You're going to look at somebody as seeing a HELOC, and it's going to be really easy. In some cases, you might already be in a project, and they're going to go, oh, this equity line, we're not going to get an appraisal on that. They don't have to walk through your house. We're just going to do drive-by. And then you call somebody like us, and we go, yeah, we might have to do an appraisal on that. By the way, it's called property inspection waivers. Those are a lot more common today. But on the side, what do you think? How is somebody going to weigh what they're going to do? A cash out transaction where they get all as much interest deductions as they can, because they are doing capital improvements to their property. So if you go $200,000 extra on your first loan, you're doing $200,000 in capital improvements, that is a really good chance you're going to be able to write off all of that as opposed to an equity line.
Well, one of the trade-offs, I always look at trade-off. I look at ease of application, ease of accomplishment. One of the big trade-offs actually with equity lines is they're easier to get. There's not a lot of hoops to jump through. Like you said, most lenders don't do an appraisal. They do a drive-by, or they look at Google Maps. And as long as you meet the credit threshold, I should say, and you have the ability to pay, they're going to give you some type of equity line, because that's what they're in the business of. As rates go up, they're leverage in. They're going to make more. They're always going to make their margin. So a lot of times it's an attractive product. So that's the reason why a lot of people look at those type of products. It's ease of getting it done.
You see a drive-through, fast food drive-through, and you're going to go. It's easier to go there, but it might not be the best food for you. Where you can just go to the grocery store right here and pick and choose what you want, which is a lot healthier. I'm not trying to get in a fight with fast food places, but you get the analogy, right? It may not, just because it's easy, it may not be the right thing to do. Be careful. That's what we just went through the email.
It requires a lot of management. That's the big thing. It's a good product.
And what's your exit strategy out of it too? You talk about an equity line is a great thing to have for this person who needed the extra reserves, or somebody. And we just talked to a lady who says, well, I don't even use money for my checking out. I just write a check for my equity line, then I pay it back, and I just do it like that. I love having it. But that might not be the right thing to do if you can't pay it back.
Well, that lady, if she's using it that way, that may sound to me like she's on top of her game. She understands how to use money, just like you were telling me. But one of our financial planners, that's all he does. Everything he puts on a credit card, and he gets a lot of benefits from these credit cards. Yep. He understands money management.
If you have any questions, you can always email us, Tony@BayAreaLoanSource.com or Gordon@BayAreaLoanSource.com. This is what we do, and we are welcome anybody to shoot us an email. 800-516-1220, 800-516-1220. We'll be right back.
This is Money 2.0 on AM 1220 KDOW.
Again to the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
Thanks for hanging with us for this last 50 minutes or so. We're here every Thursday from 6 to 7. You can go to our podcast at BayAreaLoanSource.com. You can join our newsletter there as well.
You missed something we talked about. It's a great thing to catch up.
I'm keeping up to date on those. There's a seminar coming up next week. It's a Rob Black seminar with Chad Burton. I will be there. It's next Thursday night at the Elks Lodge, I want to say. Just go to robblack.com and click on seminars, sign up. And you can use code to get in free. I think it's Radio 25. Great seminar, especially when the markets are kind of weird. Like, what are you going to do now? Everybody's been kind of doing their own thing with real estate and with stocks, and everybody feels like their own money manager. But when things get kind of hairy, that's when you really need to be prepared. A couple stories out there. We talked about the granny units. I love the fact that cities are starting to open up with granny units, but I thought this was a kind of a funny story. How seriously should parents take their kids' opinions when searching for a home? What percentage do you think it is, Gordon? 15,
20%, I'm guessing?
Much higher, which I was surprised as well. 55% of homeowners who have a child under 18 said their opinion of their child factored into their home buying decisions. 74% of millennial parents said their kid's opinion was important to them, and renters about 83%. So kids look for things like their own bedroom, backyards, pools, other activities, being close to friends, and things like that. Are you gonna listen to your kids when you buy property?
Hey, it depends on how smart they are.
You know how smart they are is mostly dependent on you, right?
Right.
Okay, your kids are you.
I mean, I think it's all relative. I think when you're any buying a house for a family, you want everybody to participate. You want to kind of consider, especially kids. They want their own room. They love the pool. They love the athletic backyards. And, sometimes it's a little bit more pricey on the side. So they love that. They don't want to share with their brother and sister anymore. So it's good to keep everybody happy. But we all know you can't keep all the people happy all the time. You can keep some of the people happy sometimes.
Which is funny that the kids want their own room at the same time. That's kind of what the parents are saying. We want our own room. Yeah. When you buy a house, you're almost buying it. And even renters we're renting with other people. We want our own. We want privacy. Look at this place for $2.6 million for 900 square feet in Palo Alto. Are they going to have privacy? Kids want the privacy. The parents are more level-headed, and they're saying, we're just going to buy what we can, or they're going to build a granny unit and stick their kids in the back, right? You want the privacy? Here's a granny unit in the back, right? And when they won't call it, they'll call it the kid unit, or here's lock it up or whatever you do at night, or put a fence around with motion sensors or whatever. Or
as the housing market does go up, and a lot of parents are doing that. You're building now instead of a granny, you're
going inward instead of outward.
Keep the kids at home as they grow up, and they can have their own basically housing just on the compound, if you want to call it. Separate entrance. They come and go as they please. They're adults, and they have access to the house.
How old were you when you moved out?
I was 21.
21? I think I was after college. So I went back when I was. I went back. So I went out when I was 18, but I went back when I was 22.
I didn't move out, by the way. I was kicked out.
Oh, you were kicked out. Okay, there's a big difference. Yeah. When were you kicked out of your house?
I was forced to swim or sink, and I think I did a pretty decent job.
My brother, his kid just graduated college, got a job, spent 2 years in the job, and then he moved back into the house. So it's too expensive to rent.
Okay.
And so we moved back into the house, and now he's like, oh, we just got rid of you. 6 years ago, we just got rid of you. And then the other kid, he's like, well, I just want to be a professional college student. So he's going to spend money over on that with that kid. And because his uncle was a professional college student, and it turned out to be some big-time corporate negotiator guy, made a ton of money. He's like, well, this guy goes to college for 12 years. Maybe I'll do the same thing. So.
Well, that's what they always say. Be careful what you ask for,
right? Anyway, so this is the Real Estate Report. Thanks for joining us. I'm actually going to be on the air tomorrow morning, same station, from 8 to 9, if you want to catch our show tomorrow. Don't forget about our newsletter that we do at BayAreaLoanSource.com. You can hear our podcast at BayAreaLoanSource.com, and you can shoot us an email, Tony@BayAreaLoanSource.com or Gordon@BayAreaLoanSource.com. We welcome any scenarios. It can be rates, it could be anything about titling or renovations, doesn't matter. We'll come back next week. Thanks for joining us. I'm Tony Mendez, that's Gordon Hines, and this is the Real Estate Report.